You've watched the videos, you've read the articles, you've told yourself a dozen times, this is the year I start investing. And yet, the money is still sitting in your checking account, doing nothing. Not because you're lazy, not because you don't care, because nobody ever sat down and showed you exactly what to do, step by step, in plain language, without trying to sell you something. That changes today. By the end of this video, you will know exactly how to build your first investment portfolio from zero. What to open, what to buy, how much to put in, and how to think about it long term. No jargon, no overwhelm, just a clear, honest roadmap. Let's get into it. How to build your first investment portfolio from zero, step by step. Before we touch a single number, let's clear something up. Investing is not gambling. It is not reserved for the wealthy, and it is not as complicated as the financial industry wants you to believe. At its core, investing is simply this: putting your money to work so it grows while you sleep. The stock market, despite every crash, every crisis, every headline, has returned an average of roughly 7 to 10% per year over the long term. Every single decade in history, it has recovered and reached new highs. The biggest risk in investing is not losing money in a crash. The biggest risk is never starting and watching inflation silently eat your savings year after year. You don't need to be perfect. You don't need to time the market. You just need to start, stay consistent, and think long term. That's the entire game. Now let's play it. Your first decision is where to hold your investments. This is called a brokerage account. Think of it as the container that holds everything you'll buy. For beginners, you want something simple, low cost, and trustworthy. Some of the most popular options worldwide include Fidelity, Charles Schwab, and Vanguard in the US. All well-established, commission-free, and beginner-friendly. In Europe, platforms like Trade Republic, DeGiro, or Scalable Capital are strong options with low fees and clean interfaces. For a global option, Interactive Brokers works in most countries. What to look for: zero or low trading commissions, no account minimums or very low ones, a clean mobile app, and strong regulatory protection. What to avoid: platforms promising guaranteed returns, anything asking for crypto deposits up front, or apps with no clear regulatory registration. Action step: choose one platform today. Don't spend 3 weeks comparing. Pick one from the list above that's available in your country, open a free account, and move to step 2. Step 2: understand what you're actually buying. Now let's talk about what goes inside that account. You've probably heard words like stocks, bonds, ETFs, index funds. Let's make them simple. A stock is a tiny piece of ownership in a company. If Apple does well, your stock goes up. If it struggles, it goes down. A bond is essentially a loan you give to a government or company. Lower risk, lower return. It's the stable, boring part of a portfolio. An ETF, exchange-traded fund, is a basket of many stocks or bonds bundled together. Instead of buying one company, you buy a tiny piece of hundreds at once. This spreads your risk dramatically. An index fund is a type of ETF that simply tracks a market index, like the S&P 500, which represents the 500 largest companies in America. For most beginners, index fund ETFs are the single best starting point. Low fees, instant diversification, and decades of proven performance. Warren Buffett himself has repeatedly recommended them for ordinary investors. Action step: look up these 2 ETFs as a starting reference point. VOO, which tracks the S&P 500, and VT, which tracks the entire global stock market. These are not personalized financial advice, just the most commonly recommended beginner instruments to research. Now comes the question everyone asks: how do I divide my money? There's a classic rule of thumb that has stood the test of time. Subtract your age from 110. The result is the percentage you put in stocks. The rest goes in bonds. So at 30 years old, 80% stocks, 20% bonds. At 45 billion, 65% stocks, 35% bonds. At 60, 50% stocks, 50% bonds. Why does this matter? Because the younger you are, the more time you have to recover from market dips. You can afford more risk. As you age, you gradually shift towards stability. For most people under 40 just starting out, a simple 2-fund portfolio works beautifully. One global stock ETF and one bond ETF. That's it. No need for 15 different funds. Simplicity wins in the long run. The best portfolio is not the most complex one. It's the one you actually stick with through the ups and downs. Action step. Decide your stock to bond split based on your age using the formula above. Write it down. That's your allocation. You'll rebalance it once a year. We'll cover that shortly. Here's the question that paralyzes most beginners. Should I invest all my money now or wait for the right moment? The answer is neither. The strategy used by the most successful long-term investors is called dollar cost averaging, and it's beautifully simple. Instead of trying to time the market, you invest a fixed amount at a fixed interval, every month on the same date, regardless of whether the market is up or down. When markets are high, your fixed amount buys fewer shares. When markets are low, it buys more. Over time, your average cost per share smooths out, and you eliminate the emotional decision-making that destroys most amateur investors. Studies consistently show that time in the market beats timing the market, every time. $300 a month, same ETF, same date, every month. That's a portfolio strategy used by millions of successful investors worldwide, and it requires almost zero skill to execute. Action step. Set up a recurring monthly investment in your brokerage account. Pick an amount you won't miss. Pick a date. Automate it. Then forget about it and let time do the work. Step 5. Manage your emotions. This is where most people fail. You can do everything right. Right platform, right ETFs, right allocation, right consistency, and still destroy your results with one bad emotional decision. The market will crash. It always does, eventually. Headlines will scream. Friends will panic. Your portfolio will drop 20%, 30%, maybe more. And in that moment, every instinct you have will tell you to sell, to protect what's left, to get out. That instinct is wrong, almost every time. The investors who build real wealth are not smarter than the ones who don't. They're simply better at doing nothing when everything feels urgent. Here's what the data shows. Missing just the 10 best trading days of the last 20 years by being out of the market at the wrong time cuts your total return nearly in half. Those 10 days often come right after the worst crashes. The people who stayed invested through 2008 through 2020, through every crisis, they doubled, tripled, quadrupled their money. The ones who sold at the bottom locked in their losses forever. Action step. Write yourself a one-page investor policy statement, a letter to your future panicked self explaining why you started, what your plan is, and why you will not sell during a crash. Seal it. Open it the next time the market drops 20%. One last thing that most beginner guides skip entirely. Over time, as markets move, your portfolio will drift from your original allocation. Your stocks might grow to 90% when you wanted 80%. Your bonds might shrink below your target. Once a year, pick a date. Your birthday works perfectly. You rebalance. You sell a small amount of what has grown too large and buy a little more of what has shrunk. You bring everything back to your original percentages. That's it. 1 hour per year. That's your entire annual portfolio maintenance. Investing is not a daily activity. It's not something to check obsessively. It's a slow, patient, boring process that rewards the people disciplined enough to let it work. Let's recap your complete first portfolio roadmap. Step 1. Choose your platform. Open your account today. Step 2. Understand what you're buying. Start with index fund ETFs. Step 3. Set your allocation. Stocks and bonds split by age. Step 4. Invest consistently. Dollar cost averaging every month. Step 5. Manage your emotions. Do nothing when everything screams sell. Bonus. Rebalance once a year. 1 hour. Done. And if you've watched all 3 videos in this series, you now have everything you need. The habits, the mindset, the portfolio. The only thing left is to start. Every great investor started exactly where you are right now, with zero invested, with questions, with a little fear. The difference between them and everyone else? They pressed the button anyway. This is your button moment. If this series helped you, share it with someone who's been putting off starting. Leave a comment with the date you opened your first account. I want to celebrate it with you. See you on the other side.